2007, our first In Gold We Trust report. Gold trading at $670. US national debt, 9 trillion. Today, gold at 4,500. Debt at 39 trillion. And the world is finally asking the questions we've been asking for the last 20 years. Welcome to the In Gold We Trust report 2026. Now, 20 reports, that's not just 20 PDFs. It's the evolution of our scope from gold to commodities to miners to silver to Bitcoin. It's the refinement of our valuation models, the expansion of our team, our partners, and also the questions we've learned to ask. In our 2007 inaugural report, gold traded at $670. Italy was soccer world champion. Netflix mailed DVDs. Steve Jobs had just presented the iPhone, but hasn't shipped it yet. A lot has changed since then. The world, the markets, and if I'm honest, even me. The hair has thinned slightly, the reports have thickened, and the gold price has gone up. 2 out of 3, I'll take it. Now, the future of monetary history lies in its past. That is the leitmotif of the In Gold We Trust report 2026. Back to the monetary future. Now, why back to the monetary future? Because every monetary system in human history has, eventually, found its way back to gold. The pure fiat experiment is just 55 years old. 5,000 years of monetary history says, this is the anomaly, not the norm. But before we dive into the 2026 thesis, it is time to say thank you to the team and to our premium partners. Now, none of this would exist without the people behind it. More than 20 colleagues across 4 continents, 20,000 hours of research, of writing, of designing, crunching numbers and producing charts. So to my entire team, thank you. And to our premium partners, the creme de la creme of the gold business, who make this research free for everyone. Without you, this report would not reach the world. Now, gold has set all-time highs in virtually every major currency for a second consecutive year. Central banks are accumulating it at the fastest pace in monetary history. And policymakers in Washington are now openly discussing what it would mean to anchor sovereign debt to the metal once again. So where does that leave us? The question is no longer whether you should own gold. The question is whether the global monetary system can function without it. So why now? The answer sits on 5 pillars. Pillar 1, government finances. Global debt has reached 350 trillion US dollars. The US alone surpassed 39 trillion in March 2026. And now net interest payments exceed even the defense budget. Government bonds, long the foundation of traditional asset allocation for institutional investors, are clearly coming under pressure. Pillar 2, anti-dollar sentiment. Since the freezing of Russian reserves in 2022, central banks have voted with their wallets. Excluding gold, the dollar's share of global currency reserves now stands at 56.9%, the lowest in roughly 3 decades. And critically, central banks have been net buyers of more than 1,000 tons of gold per year for 3 out of the last 4 years. So the de-dollarization has finally entered the mainstream. Pillar 3, Federal Reserve credibility. The new Fed chair, Kevin Warsh, told the Senate in his hearing that we're now entering, in his words, a regime change and a new framework for inflation. And here is the verdict. Anyone who needs a new framework has probably abandoned the old one. So bye-bye 2% inflation target. Pillar 4, Institutional investors are slowly waking up. US gold ETFs account for just 0.17% of US retail portfolios, 6 basis points below the 2012 peak. JP Morgan now sees room to lift allocations to 4 or even 5%. And Morgan Stanley is recommending a 60-20-20 portfolio, 60% stocks, 20% bonds, and 20% gold. Now, far from being a crowded trade, gold is a party where the first guests are just starting to arrive. The coats are still in hand, drinks are not yet poured. Central banks hold 26.6% in gold today, against a 1980 high of 62.4%. Private allocation sits at 2.7%, against a 1980 peak of 8.3%. So the room is empty, and the gap is where the next demand wave lives. Pillar 5, the next wave of inflation. Bond markets price break-even inflations as if the risk has been quietly retired. Institutional investors have moved on, but the inflationary sword of Damocles is still hanging. And obviously the closure of the Strait of Hormuz, with its knock-on effects for oil, gas and global supply chains, is all it would take to cut the thread. The 20th century alone delivered multiple inflation waves. The most recent one ended in 2023. So are we really supposed to believe that the next one is impossible? 5 pillars, 5 breaking points, all pointing in the same direction. But here is where it gets interesting. The IGWT Trust Report 2026 identifies 6 vectors of remonetization, the mechanisms by which gold is quietly returning to the heart of the monetary system. Each one alone is significant, but together they're tectonic. Now a quick word before we go on. Everything I'm sharing today is laid out in detail across more than 500 pages of our IGWT Trust Report 2026. Charts, sources, full chapters, alternative scenarios, all available for free on our webpage, igwtrust.report. And a few highlights worth flagging. The corporate gold standard chapter on why miners should put bullion on their balance sheets. The de-dollarization chapters on the world-building non-dollar payment plumbing in real time. One of my favorite chapters, Isabella Kaminska, on the stablecoin questions and why every macro investor needs to consider stablecoins and what they mean for the future of our plumbing of the monetary system. And a great chapter adapting Mackinder's geopolitical theory to the sphere of money. Each one is its own rabbit hole. If you want to see monthly updates, the Gold Compass. For commentary between editions, our Sound Money report on Substack. And for those of you who want to invest alongside us, our full suite of strategies lives at incrementum.li. Mark and I, we manage the active gold, the digital and physical gold, and the active commodity strategies. They translate the IGWT Trust thesis into action. But now back to gold. If those 5 pillars are the foundation, what does the trade actually look like from here? For investors watching this, the implication is quite direct, I would say. The traditional 60-40 portfolio is broken. Bonds no longer hedge equity risk in an inflationary regime. The replacement isn't anymore in the bond space. It's performance gold, it's silver, miners, but it's also commodities and Bitcoin. And it's now time for performance gold to shine, exactly as we forecasted in our 2025 report. Now, silver delivered its strongest annual gain since 1979 last year, up 146%. The white metal has now run a 5th consecutive year of structural supply deficit, with a 6th forecast for 2026. Now, mining stocks today represent a 125-year low in valuation relative to the broader market. The mining industry sits at just 1% of global stock market capitalization, a level that we haven't seen since 1900. And here's the kicker. The top 10 precious metal producers actually tripled their free cash flow in a single year from around 9 billion in 2024 to just under 27 billion last year. EBITDA margins expanded from 37% to 57%. Levels typically found only in the most profitable tech industries. So record cash flow, net cash balance sheets. But still, miners are unloved, undervalued, and clearly underowned. And this brings us to the question of scale. Just how much room is really there to run? Picture this. The global bond market totals around 140 trillion US dollars. The traded gold market is roughly 15 trillion US dollars. So a reallocation of just 2% of global fixed income, that is around 3 trillion US dollars. That would equal a fifth of the entire investment gold pool. So even marginal flows could overwhelm the gold and sound money market. And it's not just gold and silver. Commodities, after more than a decade of underinvestment, are historically cheap. Have a look at the GSCI commodity index relative to the S&P 500. It sits at 0.81, well below its long-term median of 3.8. And probably more Americans believe that Elvis is still alive than actually own commodities. Rarely have real assets been this undervalued against financial assets. Now this year, three thinkers helped us to crystallize the 2026 thesis, each from a very different angle. Dr. Judy Shelton makes the case for gold-backed treasury bonds, timed fittingly to July 4th, 2026, the 250th birthday of the United States. Then there's Luke Groman. He explains why gold is becoming the arbiter of global balance. And then we've got Craig Tyndale, a very successful commodities expert and investor. He shows what happens when physical bottlenecks collide with financial liquidity. The full conversations are in the report. Now, one last piece of the picture, Bitcoin. In March 2025, the United States established a strategic Bitcoin reserve by executive order. Bitcoin has crossed from anarchist money into sovereign-grade reserve asset. And Bitcoin's market cap remains a fraction of gold's. As you know, ladies and gentlemen, gold offers stability and Bitcoin adds convexity. They complement each other rather than compete. Now that brings us to the broader story, the remonetization of gold. To put gold's recent move in proper context, it should be measured against the system that it surrounds it. Since 1900, the US M2 money supply has expanded more than 2,500 times. The US population has grown 4.5 times. So on a per capita basis, M2 has gone from $118 to over 63,000 US dollars. Against that backdrop, gold has not become expensive. The denominator has simply collapsed. So where does this leave us with our outlook? Our 2020 base case of $4,800 by 2030 has already been reached 5 years early. Our attention now turns to the inflationary scenario, $8,900 by decade end. And in my view, this is no longer the outlier case. Looking further out, our new In Gold We Trust gold allocation 2045 model points to up to $20,800 per ounce and a global gold market cap of 210 trillion by the end of 2045. Now let me leave you with one observation. China is playing Go. Patient, strategic, focused on encirclement. The United States is playing poker, bluff, leverage, and the occasional all-in. And Europe is still on the table, having translated the rules into 24 languages, commissioned an impact assessment, and convened an ethics advisory board, while the others have long since cleared the chips. Gold, meanwhile, isn't playing any of these games. Gold is doing what gold has always done, holding its place. 20 editions in, the In Gold We Trust report remains your trusted guide through the gold world. Thank you for being part of this journey and for engaging with theses and concepts that even now sit far outside the mainstream. To prepare for the future of money, one must first return to its past. So welcome back to the monetary future. Or, in 4 words, in gold we trust.